PWM's latest video interview examining asset allocation strategies and investment trends of private banks. Today we look at how key macroeconomic challenges and political uncertainty are affecting investment decisions. And to discuss these topics, I have with me Didier Duret, Global Chief Investment Officer at ABN Amro Private Banking. Welcome, Didier, and thanks for joining me.
It's a pleasure to be here.
Didier, a rate hike by the Fed this summer seems more likely today than just a few weeks ago. Do you think markets are finally prepared for it?
Probably the Fed is in much better situation to raise rate than when it did last time in December. Currencies are more stable, commodities are more stable, and also the domestic situation has improved over the last 6 months. The jobs have been created. It is true that the industrial sector is a kind of a black spot, but overall we are in a much better situation that could justify higher rates in the US.
So do you think that there will be a positive or negative impact on the rest of equity markets, in particular emerging markets?
I think the emerging market, they have a much stable, let's say, background. You know, there are less outflows. It's very different from what we had in December. Probably they can withstand the situation. And it's not only regarding emerging market or equity markets, but also the overall financial market will not go in a panic mode because the Fed is simply changing the policy and make it more adequate to the situation of the US.
Mm-hmm. At the same time, the ECB and Bank of Japan are continuing to, planning to continue the quantitative easing programs. So there is this policy divergence in the world. How is it going to affect your investment outlook?
I think they are still supporting the growth as much as they can, but in a different way. If we look at the ECB, they are more granular in their action. They don't really want to push down the interest rate in a very negative territory. They are focusing very much on the credit channel, and they want to focus on certain niche on the market into the purchasing program. So it's a much more nuanced monetary policy that they are engineering.
People are becoming increasingly skeptical of the effectiveness of QE in boosting markets and the ability of affecting the real economies. So do you think maybe the side effects of QE, such as the impact on bank profitability, deflation, growing debts, and move to cash, are actually worse than the intended benefits?
Probably we are in a very mature phase for quantitative easing. And the next step is probably a more balanced policy mix, meaning that we will not rely only on monetary policy to stimulate the growth, but also to rely more on the fiscal policy. And this is probably the big thing in the coming 2 years, because we are entering in a new political cycle, and new political leaders will probably increase the change of a significant change in the policy mix, with more spending.
Mm-hmm. Do you think the bull market has come to an end?
It's always very hard to call the end of something, and in particular equity markets. But from a very common sense perspective, equity markets are not overvalued. We are not seeing huge speculation in the market. And we have still a lot of interest because interest rate and other alternative source of return are almost exhausted if you look at the bond market. So there is still flows interested to be in the equity market. We need, the only reason to call the end of the bull market is an external shock, but you cannot predict that.
Mm-hmm. What kind of segments do you favor in the equity space? What kind of markets?
I think the equity market needs to be looked at in a certain ways as a proxy for bonds, chasing for dividend, chasing for income that you don't get with the bonds. And in this area, the healthcare sector, supported by strong earnings, but also the IT sector, the dividends are low, but the prospect for earnings are pretty comfortable. And also the consumer side is betting on growth is like being defensive these days. On energy stocks, we are seeing still a very long tail, a form of inertia that was created by the big drop that we have seen in commodities and oil price. They have to reorganize, they have to reallocate and all the operations, so it will take time. It takes a lot of time to cut costs as well. So we expect still some, let's say, negative impact on the next quarterly earnings. Probably at the end of 2016, it will be the end of it, and then the earnings can come back.
And what do you expect the consequences of increased oil price to be on markets, in particular on inflation?
There will be an impact immediately visible on headlines inflation. The bad news is that headline inflation will be much higher than any form of government bonds that you have. So meaning the bonds is really not the nice place to be in this environment. So you need to find other instruments to protect against the inflation that we will see in the coming 1 year or two.
So what kind of instruments, asset classes do you favor to protect clients' portfolios from inflation?
Yeah. So this is a call to the arm to go to real assets, such as real estate, but also commodities. If inflation will go into the system through the commodity, abiding commodities, you will hedge against that. So this represents, let's say, an upstream hedge, but also, let's say, equity market because of the dividend that they provide. As long as inflation remains under the 3% target, can represent a hedge against inflation.
Mm-hmm. Today there is a lot of political uncertainty. We have the upcoming Brexit referendum, the US election in November, the migration crisis in the Mediterranean and so on. Mm-hmm. So to what extent do you think political developments should impact or delay investment decisions today?
A lot of investors are remaining on the sidelines because of these political events, but we have to live with it. What is important to concentrate is really what will be the impact of this political change on the policy that will be implemented. Will we have infrastructure programs? Will we have training programs? And that's the most important thing. Beyond the political event, we need to see the policies behind.
And finally, Didier, if you had to give 3 key asset allocation recommendations to clients for the rest of the year, which ones would they be?
Number 1 is to have a little buffer of cash in order to be agile, because the environment may bring uncertainty and volatility, and it will create opportunities to step in, for instance, in equities. So having a little buffer of cash will enable to reallocate. And also focusing on real assets, being overweight commodities, having a decent portion of real estate in the portfolio, and also being overweight equities. That's one of the elements in order to capture the risk premium, decent risk premium that you got on equity markets.
Thank you very much, Didier, for joining me.
Thank you, Elisa.